Hi and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture and journey towards financial freedom that will cover financial products and financial well-being so you, like me, can reach your goals sometime in the future. Now let's get into the latest video. Now first of all, before you start investing, ask yourself a simple question about the stock or the equity that you are thinking of buying. If you don't understand it, how they make money, how they generate profits through their business model, then don't invest it. Quite simply, invest your money into a simple cash deposit or building society account. Now, firstly, invest in what you know and understand. Whether this is a particular market that you work in, or maybe a specific market that you know have done some research about, or some kind of background into the knowledge of company, so you know how it's performing. Now, we all know which companies are doing well and considered successful due to the products or value they create to the consumer, or let's just say, do they have a circle of moat? Are they some kind of protected? Is it difficult for new companies to gain a market share within that specific sector? Now, some simple global examples may include Apple, Microsoft, Coca-Cola, Visa, to name a few. And in the UK, maybe simple examples, shall we say, Diageo, BAE Systems, okay, BP, Shell. Learn to stay within your circle of competence. Now, my main holdings in the UK are considered safe, secured, somewhat boring. Let's just say Aviva, Legal and General, Lloyds, HSBC, BP, Shell. They've been around for, let's say, 100 years. They will still be there in 100 years because they've got a circle of moat and they currently evolve to meet market conditions in future. Now also consider if a company is making profits, if it has very little debt, and is it increasing profits, earnings per share, dividends on a year-on basis. That is the ultimate aim. If it's meeting them to certain criteria, there is only one way a share price will go, and it will go up, and an up market trend, no matter how the overall market is doing. We need to learn to avoid market noise and short-term market sentiment, such as recent interest rate rises, latest employment figures, shall we say, the price of oil, certain commodities. Unfortunately, bad news sells, and most things that make the market react on a daily basis are out of your control. As an investor, you'll have good years, you'll have bad years, you'll have good months, bad months, but the idea is to stay consistent. I personally aim for an annual return of 10% each year. As a comparison, the world's biggest market, the S&P 500, has delivered an annual return of around about 8% for the past 100 years. How you react to short-term market noise will massively improve your investment terms. If you think long-term, you will ultimately be the market. In a recent survey over a 20-year period, it was found that 95% of large cap actively managed funds have underperformed the market benchmark. Now, this can be attributed to many things such as concentrating a portfolio, resulting in excessive fees. They may hold a higher proportion of cash. They may charge clients excessive fees, let's just say between 1 and 2%. And as an investor knows, shall we say, chief executive shareholders, they want some kind of so-called market returns. Now, can they justify their returns? Whereas most, shall we say, relative investors only have to meet their own criteria. So why are they investing? They don't have to meet, shall we say, the goals of the investment houses of who they operate. Now, a simple analogy or example is, let's just say, if we go into a recession or a period of high interest rates, people will ultimately have less money in their pocket to spend, so we may avoid what we call big ticket items such as a newer car, holidays, upgrading the latest TV, or let's just say furniture and home. But we still need to buy essential items such as gas, electricity, utilities, food, shelter, what we call essential items. Okay? But we may come back, shall we say, on socialising, eating out, hobbies, recreation, subscription packages, shall we say, to save costs. So certain areas of the company were affected, but we still need to put fuel in our car to travel to work. We still need to pay our monthly phone bills, contract bills, shall we say, unless we cancel those contracts. So think about what sort of factors or situations are affected based upon the wider economy. Now, as the world's greatest investor said, Warren Buffett states, stay within your circle of competence and hold on to the good shares for many years, and you will ultimately be handsomely rewarded. Now, you don't have to own numerous shares across numerous different sectors or companies. You just have to get a few limited decisions right in your lifetime. But the idea is not to swing or invest at every share of the market, but limit your losses. And rule number one is not to lose money. Okay, so limit your losses and learn from your investing mistakes. Even seasoned investors don't get every decision right all the time, but you don't have to own every share. I may limit it, shall we say, to 10 shares, 10 funds within a portfolio. Would you invest money in your 10th share as your largest share, as a simple example? Okay, and remember why you bought that share or fund in the first place. Okay, and learn to invest in the tax-free wrapper and learn to reinvest all your dividends in your portfolio, and it will grow solely through the power of compounding. Now, the simple rule is don't invest in a company you can't explain how it operates in a simple few sentences, or don't invest in a company that you know nothing about. So do your research into a respective company before you buy it, or let's just say into that respective fund. Tips, ideas, hence of my own personal opinions. Remember, if you like the videos, smack the like button, subscribe to this channel so it grows to a wider audience. Now let's carry on with the video. Now it may well be that you change your investment mindset, shall we say, and most investors will ultimately sell the share after it's gone a loss in value, so they'll ultimately crystallize a loss. Remember, a loss is only a loss on paper until it sells. Find out why that company has lost value in the first place, shall we say. It may be short-term market reaction to results or a trading statement, or it may well be a specific sector, shall we say. Oil price has gone down, so oil shares go down, shall we say. Retailers are, shall we say, struggling in the high street, so all retailers will go down. But not all companies will be affected. There are good companies, there are bad companies within each sector. Okay. Could you just improve your investment returns buying shares, extra shares within a company if it has reduced, shall we say, a sudden market loss? Can you buy it and take advantage while the price is, shall we say, at a reduced basis? And also, shall we say, to beat the market, improve your chance of success, avoid constant dealing and changing your shares or funds, and limit the number of shares and funds you own so you make them easy to manage. I personally set myself a minimum amount I invest, so we say of a few £100 for each share, but I also buy what we call on a regular investment day. So instead of paying normal fees, let's just say £10 to £15 for each share or each fund, I will pay myself, or I will be charged a fee of £1.50 whether I buy £100 or £1,000 within a respective share. So save yourself on dealing funds, shall we say. And I personally, shall we say, learn to invest on a regular basis, whether it's my pension fund or my ISA, on a set date each month to reduce fees. If you're paying excessive fees, you will not get rich. Only your advisor will get rich, or your platform providers will get rich. Right? And there's a great saying in that state, I would say, no one should care more about your money than you, not your financial advisor or your broking firms. So learn to take an interest in assets and learn to understand how they are performing, and review your portfolio on a monthly or annual basis. Now, don't look at your prices every day. You may see a market of green or a sea of red. You will just drive yourself mad. Okay. I personally review my investments just as a, shall we say, valuation every month. Okay. But think long terms. What are your investment targets? Now, it may take you 5, 10, 15 years or longer to build a sizable portfolio, let's just say of £50 or £100,000, but you will get there in the end by the actions you take, and you will beat the vast majority of investors. Okay. If the idea of investing may seem daunting or overwhelming as you start out, so you may want to pick, shall we say, individual companies, then simply stick to buying a low-cost global ETF tracker, so-called passive investment. It will track the market. Your fees are much lower, but it will give you a greater exposure and diversity across numerous sectors and countries. But again, the vast majority of these funds will beat actively managed managers who will charge you much higher fees. And again, can those fees be justified compared to the investment return they are supposedly be producing? Okay, so if you are concerned, buy yourself a simple low-cost tractor, and then as your experience grows, then diversify into, shall we say, funds, holdings within specific sectors. Remember, if I can build a size portfolio of six figures, so can you if you take the appropriate steps, and you will beat the vast majority of investors by thinking long term, doing your research, and shall we say, selecting good quality companies, shall we say, and hold them on for many years. But think, why did you buy that company in the first place?